Most people remember the 2008 crash as a sudden explosion, the day Lehman Brothers collapsed in September and the world ended. But that's a dangerous myth. For the modern investor, the truth is much more subtle and much more terrifying. The S&P 500 actually hit its absolute peak in October 2007. By January 2008, it had already bled out 13% of its value. And yet almost nobody was panicking.
Why? Because they were standing on what I call the plateau of false hope. Today, we're going to look at the gravity of capital and why the most dangerous part of a crash isn't the fall. It's the recovery that never comes. Just a note before we start. This video is for educational purposes only and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses.
As we said, back in October 2007, the S&P 500 had hit its absolute peak of the time. By January 2008, it had already bled out 13% of its value, but between February and June 2008, the market just sat there. Even after Bear Stearns, one of the biggest banks on the planet, effectively collapsed and had to be rescued in March, the market only dipped about 6%. Investors were breathing a sigh of relief, saying, "Okay, that was the bad news. We survived it. Time to buy the dip."
Here's the lesson. Market falls are actually relatively easy to see, but it's the recovery that ruins people. We have this psychological sunk cost bias where we want to win back our losses so badly that we jump at the first sign of a green candle on the chart. In the summer of 2008, people thought the elevator had just stopped at the 5th floor and was heading back up. Instead, the cables snapped.
From September 2008 to March 2009, the market didn't just fall, it disintegrated. But here's where it gets cruel. Even in the middle of that total collapse, there were 2 days in October where the S&P 500 gained 10% in a single day.
If you were a day trader, you would have sworn the bull market was back. But it was a trap. We call it a dead cat bounce. The slide lasted for 18 grueling months. It wasn't a car hitting a wall. It was a slow, agonizing realization that everyone was dumping stocks and fleeing to the safety of cash.
Now, why did 2008 recover faster than the dot-com crash of 2000? It comes down to what I call demand pull. Think of your money like water. It has to flow into a container. In our investment cake, there are 3 slices: revenue, speculation, and store of value. Between 2002 and 2007, the real estate slice of that cake was soaking up all the money. But in 2008, the real estate container itself cracked. Suddenly, property wasn't safe, and because the Fed slashed interest rates to zero, bonds were unattractive. Investors had nowhere else to go but back into stocks. That is the gravity of capital.
So, brings us to today. Is AI a 2000-style bubble? Maybe, but look at the landscape. Real estate, stagnant because of high rates. Bonds, better than they were but still struggling against inflation. Gold and crypto, both at all-time highs, meaning it's an expensive entry point. This suggests that even if AI tech stocks stumble, capital might not have a better place to run. History rhymes, but it doesn't repeat. A crisis is usually born from the sector everyone thinks is safe. In 2000, it was the internet. In 2008, it was housing. What is the safe bet today that everyone is ignoring?
To wrap up, remember 3 things. Firstly, crashes, at least the ones that cut 20, 30, or 40% from the market value of equity funds, take time. For the once-in-a-generation type crash, like in the years 2000 and 2008, it's an 18-month erosion, not a single day. Secondly, follow the money. Look at where the volume is going. Gold, bonds. That tells you how long the recovery will take. Thirdly, remember that these comments relate to equity funds and indices such as the S&P 500 and the NASDAQ. However, history has shown that commodities, gold, crypto, and even fixed interest bonds can be much more volatile. Finally, remember, history doesn't always repeat itself, and the investing world has changed massively since 2008. Each crash has its own trigger, so betting that past patterns will play out again is a quick way to lose big time.
Thanks for listening. We've summarized this entire 30-video series into a book available now on Amazon Print and Amazon Kindle ebook. Check out the link in the description. It covers these topics in much greater depth than a single video can allow. And check out our next videos on the other crashes and market slides of the last 30 years. See you then.